Welcome back, guys. This is going to be the very last chapter of the entire class, okay? And that is to finally get to the closing process, okay? Now, in this case, right, where we were talking about the steps to the accounting cycle. If you guys remember from way back when I first introduced you guys the accounting cycle, which is the very first week of class, right? I told you that we are going to be taking a look at steps 1 through 3, okay? Now, in this case, when we started the coffee cafe, I introduced you to the general ledger, and we got to take a look at an example of a trial balance. Now, from here on out, from when we start processing the closing process, when we reach the end of the month, which is our accounting period, we're going to be taking these last steps to finally close up the books and wrap up the books and get ready for the new accounting period. So in this case, we will be looking at steps 5 through 10 of the accounting cycle, okay? So I've mentioned before, right? When you reach the end of the accounting period, you must complete an unadjusted trial balance, okay? So what the unadjusted trial balance basically says, it's just the very last trial balance that you just have to complete at the end of the month, right? For us in Coffee Cafe, we want to be, I tested you to do the trial balance every week, so then we don't ever have to make a mess up and we have to locate it somewhere in our books. I'm doing a week-to-week trial balance just to ensure the accuracy of our accounting, but also to make sure we don't have any mistakes here and there. So far we've been doing good, right? We still have one more to do for week 4, and then we have to do an unadjusted trial balance at the end of the month, right? So this is exactly what's going to happen, is that you're just going to tally up all of your accounts, and our goal is to make sure that our debits and our credits match, okay? Now this, once again, this is going to happen at the end of the accounting period. So for us, it's going to be June 30th, okay? And, okay, sorry, I forgot to mention this, right? The closing process for Chapter 13, the only exercise we have to do the closing process is Coffee Cafe, okay? That's why I saved it for the very last thing, and this is why I'm teaching it to you now, because we're getting very close to the end of Coffee Cafe, and this is what we're going to do. We're going to use Coffee Cafe as our example for Chapter 13. So there's no Chapter 13 exercise. You already have it through Coffee Cafe, and we will be practicing this together. And I'm not going to leave you stray. I'm not going to have you guys do it on your own. I'm going to walk you through every single one, okay? So there we are. Step 5, we're going to practice our debits and credits, right? So in this case, our accounting period ends at the end of the month. So when June 30th rolls around, we're going to do our last trial balance, okay? Just to ensure the accuracy of our accounting and making sure that we didn't make any mistakes from the 28th all the way to the 30th, okay? Once we've done that and we got our debits and credits to match, step 6 is going to come into play, right? Where we're going to be doing our adjustment entries, okay? So what is the adjustment entries? Number 6, okay, so we've talked very briefly about this. This is where we're going to adjust our accounts, because there are certain accounts that must be adjusted at the end of the accounting period. So a good example is periodic inventory, right? We have the coffee mugs that we need to adjust. All right, we have depreciation, right? We have a bunch of fixed assets that we need to depreciate because we used it for the month of June. We also bought some supplies, so we need to adjust our supplies because we use those supplies. So therefore, we need to make sure that in our books, we reflect that we don't have $150 worth of supplies. We only have X amount left. So we need to be able to represent in our books that we end up using those supplies. Okay, we have to do cost of material, right? Because we need to make sure how much it costs us per cup and per, for the sugar and creamer, all that stuff. We need to make sure all of those are adjusted. And then last but not least, bad debt expense, because we learned that in chapter 10, right? We have an accounts receivable, so therefore we have a possibility to represent that bad debt expense, okay? So those are all the adjustments that we've learned throughout this entire course, right? We did depreciation chapter 11, bad debt chapter 10, periodic inventory chapter 5, I believe, and so on and so forth, right? And so these are things that are familiar, and we're going to practice doing it. So this, again, there's a reason why I taught you all of this, so then we're going to piece them all together. So all of these concepts we've learned, we're going to piece them together by computing the necessaries to make this adjustment entry. Okay. Now, once we've done that, right, we are going to journalize those adjustments, and then we're going to update our ledger, right, once again. So then we need to do what's called a adjusted trial balance, okay? So that means we need to make sure that all the adjustment entries that we place in our journal, right, and then place into our ledger needs to make sure that we didn't make any mistakes along the way, okay? So, and in this case, I'm going to have you guys also practice using the main accounts, because when we dive into the financial statements, it's going to be a lot more easier to compute. So we'll talk about that when we get there, okay? But here, right, every time you use the journal and every time you post to the ledger, you must do a trial balance, okay? That is why, if you look at the accounting cycle in the very beginning, why are we doing trial balance after trial balance after trial balance after trial balance? It's because we're going to be using the journal every single time we do these things. And in order to make sure that we did this correctly is to run a trial balance. Okay, so in this case, after we do our adjustment entries, we must run our adjusted trial balance just to make sure that we correctly adjusted each account accordingly and making sure our debits match our credits. Okay. Then we're going to produce our financial statements. Now, the order of the financial statements is very, very, very important. Okay? Very first one we're going to do is going to be your income statement. The income statement, right, is straightforward. You're going to take all of your revenues and counter them against all of your expenses. So any operating income, any other income, any operating expenses, any non-operating expenses or other expenses, all your cost of goods sold, all of those are going to be in this table here. And how we organize it, you're going to start with all of your income first. You're going to counter against them by your cost of goods sold, because that's directly correlated to your sales, right? Because you're trying to sell your inventory, so cost of goods sold is directly correlated to your inventory. Then once you get that, you're going to get what's called a gross profit. That gross profit, right, is then going to be countered against every single expense that you've incurred in order to operate your business, right? Once you've done that, then you'll get that little opportunity to either add any extra income or take out any extra expenses, okay? And then once you do that, then you'll get a number at the very bottom. If it's positive, you made a net profit. If it's negative, you had a loss, okay? Meaning your expenses exceeded your revenues, so that's your net loss. But if you had a profit, then your revenues exceeded your expenses. So you always want to look for a positive number in most cases, okay? As a small business that's just starting up, you will see loss after loss after loss after loss, because usually in the very beginning of the period of its life, all you're doing is buying this for the restaurant, or for the store. You're buying this, you're buying that, you're paying for this, paying for that. So all of those you're more likely to get a net loss in the very beginning. But in this case, that's exactly what we're testing. We're testing to see if our total revenues exceed our expenses, okay? And once we've done that, we get a net profit or net loss. This is very important because it's going to contribute to the very next financial statement that we are going to be doing, right? So if you have a net profit, okay, you have a choice as an owner, okay? You can either pocket that profit or you could reinvest that profit into the company, okay? Now, if you have a net loss, right, that means your company has to take a hit. So you can't pocket that loss out from your own pocket, okay? And that's where the next part's going to come into play, because if you decide to reinvest that money into your company, or if you have a net loss, you have to take it away from your company. So this is where the statement of owner's equity is going to come to play, right? First thing you need to do is you're going to start off with your ending balance, your beginning balance of your equity, okay? Whatever you started out with, your original investment, okay? If you have a net income, you're reinvesting money into your company, you're going to increase the account. If you have a net loss, you're going to decrease your account, okay? Any other contributing factors, such as a capital contribution, maybe you invested a little more money of your own money into the company, it's going to increase owner's equity. And if you took money out from your company, you're going to decrease, okay? Vice versa. So with that being said, is when you must complete the income statement first and make that decision, right? Now, oftentimes, the best rule of thumb is you should reinvest that money into your company, especially in the beginning of its life, because you need that money because you owe bills, you have to pay this, you're always constantly buying new stuff for your store. So within the first year, you should always reinvest that money into your company, because that money then becomes a possibility for you to expand your company. All right. So always reinvest into your company in the very beginning. So the assumption here is that if we have a net profit or net loss, we're going to reinvest into the company. Okay. So here, that will determine us a brand new total value of your company, right? Because we talked about equity. Equity is your net worth of your company. It's what the company is worth at what its standing point is. So if I started off with $20,000 or $2,000 and I got a profit, then it's going to increase it by however much your profit is. Okay, and this number is also very important. Once you figure out what your equity is at the end of the month or your accounting period, this number is going to be automatically taken into the next worksheet, which is your balance sheet. Okay, so in this case, right, the balance sheet, right, is going to test the accounting equation, which is totaling up your assets and putting them against your liabilities and your equity. Equity is given because you solved it from the previous worksheet or the previous financial statement. So you're going to take that equity and you're going to pop it in here. So all you're really doing is you're listing out all of your assets, right, totaling them up, and then you're going to list out all of your liabilities, because equity is already given. You add those two numbers together, right, your liabilities and your equity, and you're going to compare to your assets. Does your accounting equation hold true? Do your total assets equal your liabilities plus your equity? And if they do, then we're good to go, right? That means we balanced our accounts correctly. Now, for any reason that it is off by something, you either made a mistake in your worksheet, okay, from the previous worksheet, or you made a mistake recording your assets somehow. You forgot to include a certain few things in there, okay? So again, it's also testing your accuracy of, do you know how to use your general ledger, or putting them together here, okay? So again, if your assets do equal the total of your liabilities and your equity, then we're good to go, and we can move on to the very last statement, which is the statement of cash flows. Okay. So the statement of cash flows, right? In essence, what this is basically taking anything that's accrual basis, And we're going to convert it into cash to see and determine how much cash is actually flowing into your company and how much cash is actually flowing out from your company. So this is basically it's testing the cash basis of the accounting. So since we've been doing accrual, right, we're going to take all of those accrual accounts, so anything like accounts payable, accounts receivable, any non-cash transactions, so depreciation, all of those are going to be converted into cash, okay? And how we understand it is pretty straightforward, right? Our net income is going to be the very first thing that you have here because our net income is all of our sales minus our expenses, right? And in this case, the very first thing that you're going to do is you need to make sure which expenses, right, were non-cash, which is your depreciation is non-cash. Your bad debt expense, right? That's invisible money that you didn't even have in the first place, right? Did you spend money to depreciate your assets? Of course not. So we need to reverse those, okay? Other contributing factors is accounts receivable. Did you actually receive the cash from your customers? No, you didn't. Instead you took them as an IOU. So that's where you're going to subtract that money from your net income because you never actually received that cash. Same thing with your accounts payable, right? Did I ever pay my bills? If you did, then of course then you wouldn't have that accounts payable account in the first place. But if you still owe those people, right, money, those accounts payable essentially means that you still have that money. You never paid them off. So that's money that you have. All right, and so on and so forth. So it's going to be broken into 3 categories. The first one's going to be your operating activities. So anything that has to do with your operations, your sales, your assets, your liabilities, okay? Now, in this case, more specifically, it's going to be your current and other assets and your current liabilities, okay? When we talk into investing activities, what money did you put out to invest for your company? Which is going to be anything that's a fixed asset, okay? And then last but not least, we have our our financing activities. So these are going to be determined as your long-term liabilities and your equity, okay? So again, after we complete the balance sheet, what you do is you're going to take your balance sheet and you're going to convert it into the statement of cash flows, okay? With a few inserts from your previous adjusted balance sheets, okay? So in this case, you're going to have your unadjusted balance sheet as well as your unadjusted balance sheet because we need to get actual numbers for how much you actually paid for purchasing the fixed asset, okay? So that's what you're going to do. You're basically taking your balance sheet and you're mixing it with your income statement and you're creating what's called the statement of cash flows to actually determine how much cash is flowing into your company and how much cash is flowing out from your company. Okay. Once you've completed that, that's just doing the financial statements. Then we're going to start moving on to step number 9, which is actually closing out your books. Okay. So if you remember this from way back when, closing out your books is basically taking all of your revenues and taking all of your expenses, which we call them temporary accounts, and we close them out at the end of the given period. So then when we start a new counting cycle, everything is at 0. So we can have a perfect measurement of profitability, because we're starting at 0 every single at the single end of the accounting period to give us starting point at 0 to be able to measure our profitability. So how do we close them out? Straightforward. You zero each account out. So for example, right, if you understand that revenues have a normal balance of a credit, in order to zero out that account, you're going to debit all of your revenues. Okay, and we have a special account, especially when you're doing sole proprietors. It's called our income summary. Okay, or if you guys remember, I talked about corporate terms. Corporate is retained earnings. Okay, but we're looking at sole proprietor or a partnership. Even if you're looking at a small company, our account that we're going to be used to zero out these accounts is going to be called income summary. So that's the very thing that you're going to do. You're going to zero out all of your revenues by debiting all your revenues into income summary. Okay? And you're going to do the same thing for your expenses, right? If expenses normally have a debit balance, your job is you're going to credit every single expense to zero out each account, and you're going to credit them all out to income summary. Okay? So here's an example, right? You're going to debit all of your revenues to income summary, okay? And then you're going to credit all of your expenses to income summary. And once you've done that, your next step to do is you're going to close out your income summary to your equity account, okay? And this number here should match your profit. So your income statement should reflect that same exact number. Okay? That's how now everything is piecing together and making sense, because now everything is coming together and everything is matching 100%. So once we've done that, right, and we journalize this, okay, we also have to do our last things, which is to update our equity, obviously. So if you have any capital contributions or any owner's withdrawal, you're gonna also journalize those as well. You're gonna close on everything out to equity. Okay. Once you've done that, your last step that you have to do is, once again, do your post-closing trial balance, okay? To just once again make sure that you properly zero out all of your income and all of your expenses, and you zero them all out to your income summary, which you zero that out to your equity. So that means your equity should match everything in your books. So therefore, your statement of equity should match. Your balance sheet equity should match. All right? And once we do that, we are done. And that means we can go ahead and start the next accounting cycle. Okay? Any questions here? So once again, we talked about the last 5 steps of the accounting cycle, right? Here's a little brief reminder of what a trial balance does, right? A list of all of your accounts, and you're going to determine whether your debits and your credits match. How we deal with closing the books out is you're going to debit all of your revenues, you're going to credit all of your expenses, and you're going to either credit or debit, depending on what it is, what kind of account balance you have in your income summary, and close your income summary out to equity. Okay? And these are the 4 financial statements with bullet points on exactly how you compute them. Okay? Any questions in regards to chapter 13?
I do.
Yes.
So the equity that we're supposed to be zeroing it out at the end on the previous slide that you said, those numbers coming from these statements, because where's the integrity of the information? Where's the background? I can just write that down, zero it, and it may or may not.
Which one are you talking about? Like the closing out the temporary accounts, or closing out the
Yes, temporary accounts.
those numbers are going to come from your ledger.
Okay.
Yes. So everything that we're going to be doing is going to be dealing with the ledger itself. Journal, ledger, always. Journal, ledger, journal, ledger, journal, ledger, always. So all of these numbers that you're computing from the financial statements are all coming from. So we talked about the couple trial balances before that. Those are come from. So creating some of them, the financial statements. Those are all going to come from your adjusted trial balances.
Okay.
Okay? It's just your, when you close out your equity, that all comes from your ledger.
Okay, thank you.
Any other questions?